And hello, Savannah, Georgia. Thank you for tuning in to Real Estate Real Talk with Julia Spencer on this last week of the year. Isn't that amazing? We're already at the last year. I can't believe how fast the year went. I hope you have some really good New Year's resolutions. Also, I hope you had a great holiday and you were able to enjoy relaxing times with friends and family. And we're kind of very short-staffed here at the station, but I am here in town, so I decided to do my real estate shows anyways this year, this last week, I mean. And last week's show, I actually went over a couple of really brief tax tips. And today on the station, I want to talk a little bit more about that. So you're listening to WRUU-LP, Savannah, Georgia, 107.5 FM, WRUU.org. We are Savannah Soundings Community Radio with Global Soul. You're tuned into Real Estate Real Talk with Julia M. Spencer. And let's expand a little bit on this tax discussion. I can actually talk probably for weeks on end about taxes. One of the things that kind of comes along with being a real estate investor is you become a tax expert very, very quickly. Not willingly. It's usually because you're forced to. But nevertheless, it's actually very useful also in your everyday life. So last week I kind of just went over some very basic general things that you can do to help yourself with your tax return this year. And this week, I actually had the chance to go over and do a little bit of research and go a little bit over some of the tax implications of our new tax bill that was just passed. And I wanted to kind of share those with you. Now, before I get into sharing my opinions with you, of course, you can always reach me at realestate@juliamspencer.com. That's my email. You can also find me on social media. You can just type in my name, Julia M. Spencer. I always tell people the M stands for money. It can also stand for mom or middle initial. But you can easily find me. You can contact me, give me feedback, questions, comments. And also wanted to say that the viewpoints expressed in the following program are not necessarily those of WRUU, its license holder, or its staff. So with that in mind, let's just jump right into it. And also, I have a couple of songs that I picked out for you because I am actually broadcasting live. I'm in the studio here in Trump Square, downtown Savannah. It's a little bit of a dreary day today, so I tend to pick songs that are a little bit dreary, so that'll give me a little bit of a break. But let's talk about these new tax implications and specifically how they apply to real estate investors or even just homeowners. And again, I'm not an attorney and I'm also not a tax professional. And that was pointed out to me actually on one of my videos. And if we have time, we can talk about that. But if you have any questions about this, you can always ask me. But also, I would always recommend you go to a CPA or a tax professional that can give you more information about these things, because I wanted to just touch on these things briefly. I don't want to go into too much detail because obviously everybody's situation is a little bit different, and your portfolio is going to look different than mine in your tax situation. Of course, it's a big picture type thing. You can't just like look at one little piece and say, okay, right here, this is going to apply to you, or it's not, because I haven't seen the whole picture. So let's talk about the first thing. And I actually got this from an article off the internet on Bigger Pockets. It's a real estate investing website, and it was sent to me in an email. So I kind of I'm going to just read it off a little bit and comment on it. So that the article is actually called 16 Highlights of the New Tax Bill. So number one, after much debate, the primary home gain sale exclusion did not change. That's kind of a good thing. It's basically, what that basically means is that if you own your home, like it's a homestead and you live there, and you decide to sell your home at any point in time, and this is the same in the past as it will be in the future, and you lived in the home for at least 2 years out of the last 5 years, you can sell a home without having to pay any kind of capital gains taxes, as long as it's $250,000 for a single person or $500,000 for a married couple. And basically what that means is, let me just give you an example, because I actually had this question from another investor. Got a little bit of an argument with that investor. I don't know if he's listening today. But basically purchased a home for $184,000, I believe, here in Savannah. I'm not going to say any names. I've actually looked up his home, and he put about $10,000 of materials into remodeling a kitchen, and maybe even the bathrooms was his intention. He's doing all the work himself, so there was very little labor costs involved in this, from what I understood. But he believed that he could sell his home for about $400,000. And we got a little bit of an argument about whether that home is actually going to be worth $400,000. And by the way, if he's listening today, it definitely is not. Maybe $230,000 or $240,000. I looked up the home. And but, as always, I tell everybody, I don't want to shoot people's ideas and dreams down. If you think you can get the price that you think you can get for a home, and you can find a realtor to sell it for you, by all means do it. And a home is always worth how much a buyer is willing to pay for it. So, that being said, he's going to have a profit. Let's say he does sell it for $400,000. He's going to have a profit of approximately $184,000 plus any of that money that he put in the home for the materials. So let's say if it was $10,000. Let's just roughly say it's about $16,000. So he put into the home $200,000. He wants to sell it for $400,000. So the difference between those two amounts, the delta, is $200,000, which definitely goes below the $250,000 capital gains exclusion for a personal primary home. So he wouldn't have to pay any taxes on that gain. So far, so good. So if you are married, the maximum is $500,000. So you don't even need to worry about the $250,000 if you have a home that's maybe worth $500,000, and or I'm sorry, if you have a profit that's about $500,000 when you sell it, it's still going to exclude you from having to pay the capital gains taxes. So let's get to the second point. Home equity line of credit for primary homes are no longer tax deductible starting in 2018. That's a bummer. I mean, that's actually a bummer. That has actually applied to, or did apply to me at some point, no longer does. But let me just explain that to you. So basically, if you have a mortgage on your home and you've had it for a while, and this applies to homeowners that are not investors. So listen up, Savannah listeners, if you own a home. If you had a home for a while and it's just been sitting there and you've been paying the mortgage on it and everything's fine, and basically you decided to make use of that equity. So you've paid down your loan. It's one of those things that are so awesome about real estate. Whether you're a homeowner or an investor, over a long period of time, you pay down your mortgage. And then basically what happens is that you now have equity sitting there. You have money that's sitting there. And instead of just having it sit there, which is what a lot of people do, I and other people like myself as an investor would like to make that money useful, make it work. Otherwise, it's just equity that's sitting there. I call it lazy money. So what I've been doing in the past is I would take some of my investment homes that have equity sitting there, and I would get home equity lines of credit, short HELOC, HELOC. And I would do this for my primary home. Investment homes is what I used to do it, but you can do that for your primary home also. Take that money out and use that money for a down payment on another home. And once you have, in the next one that has equity, take a HELOC off on that one and buy another home, and you just keep on going and going. And so the cool thing about that is you don't have to worry about trying to find a good place for your down payment if you don't have it necessarily available right away. And you can keep continuing building that pipeline of investment houses and just adding them to your portfolio. So the new tax bill actually, unfortunately, will not let us deduct these HELOC costs on our taxes, which is kind of like a bummer. So, but you can always, this is for your primary home, that is, but you can still tax deduct the HELOC interest that you're taking out. You can still tax deduct that off your investment home. So on your primary home, it's a no-go anymore. But if you have investment homes and you use that HELOC or line of credit to take out from your investment homes to buy additional investment homes, that's still possible. So, in my case, this didn't make a difference. If you had planned to take out a home equity line of credit, though, on your primary home, for example, to do an addition or maybe remodel or go on a vacation or whatever, no longer tax deductible to you, unfortunately, starting in 2018. So those are the two first points. We got a lot more to go. In fact, I'm probably going to have to do a second show on this. But let me just go ahead and take a little bit of a break, and we're going to get to the next couple points here in a minute. While I have you, though, I'm going to just remind you that you are listening to WRUULP, Savannah, Georgia, 107.5 FM, WRUU.org. We are Savannah Soundings Community Radio with Global Soul, and you are listening to Real Estate Real Talk with Julia M. Spencer. And thank you for listening to Real Estate Real Talk with Julia M. Spencer. I am your host here in Savannah at WRUULP. And thank you for tuning in. Our discussion today is about the tax implications of our new tax bill that was just passed, specifically how it applies to homeowners and investors of real estate, which I am one of. And we're in the last week of the year, so this is kind of important. I had actually planned to do another show and instead kind of squeeze this one forward because I think this is very important to some of us. And that song actually was by Mobley. It was called Solo. Very cool artist, by the way. Came here to Savannah several times in the last couple years from Austin, Texas, and I got to meet him personally. So he's an amazing musician. Anyways, let's get back to the discussion about taxes. Can't get distracted on music too much. The next thing that I wanted to talk about is that interest deduction is limited to the first $750,000 of debt taken out after 12/15/2017 on primary and second homes. So I don't know if this applies to you. It may apply to some of you listeners here in the Savannah area if you own homes that are that you purchased after like this part of the last 2 weeks of this year, $750,000 type loan, then this kind of applies to you if this is your primary home. But let me just give you an example. So let's say you purchased a home that's $1 million here in Savannah or really anywhere. After December 15th of this year, and it's your primary home where you intend to live, well, you can only deduct the interest up to $750,000, not up to the whole $1 million, which is kind of like a bummer. But then again, realistically, and I'm going to voice my opinion publicly, if you can afford a home that's $750,000 or more, you probably don't worry too much about the interest deduction. I'm just going to put that out there, and I'm willing to get beat up for this on my emails and comments and things. In any case, my primary home and my second home, neither one of them are $750,000, so this doesn't apply to me in any case. And I didn't take out any debt after 12/15/2017, which is in the last 2 weeks, so not a big deal for me. However, this may apply to you if you're planning to purchase a home that's worth more than $750,000 in the future. Now, if you own investment homes like myself, which most of my homes are investment homes, and I think I've mentioned this on the show before, the fact that I actually don't live at any of the homes that I own. I actually rent where I live, and that's just for convenience. All of my real estate, the mortgage interest is tax deductible because they're all investment homes. So if you're planning to purchase a home, if you're in the market to purchase a home that's worth more than $750,000, you might want to consider just renting it instead. This kind of like putting out there, there's always a way to get around any of these tax these new tax rules to make it beneficial for your bottom line, basically. Now let's get to the next point here. Number 4. Number 4 says business and entertainment expenses are no longer tax deductible starting in 2018. So the website here, Bigger Pockets, actually recommends that you should prepay for your entertainment expenses by 2017 end year, if appropriate. Now, business expenses, okay, what is that even? How does that even apply to you if you are a real estate investor or a homeowner? It doesn't apply to you if you're a homeowner at all, actually. But if you have a business and you have real estate that you run as a business, like myself, or even if you are a business owner, period, it doesn't even have to be in real estate, your business entertainment expenses are no longer tax deductible. So these could be things like entertaining clients or guests, or even other people that come to your business, prospective clients, and you invite them maybe to a show or something. I mean, you got to be very careful with a lot of these things because they kind of go into that gray zone of IRS rules. And my personal philosophy on this is I try not to put any business entertainment expenses on my tax returns whatsoever. Or at least I try to minimize them as much as possible. And of course, we all do business entertainment expenses for ourselves if it kind of applies to the business. So, I do go to a lot of timeshare sales presentations, and along with that, of course, comes the travel to get there and the food expenses along with that, which is, by the way, my next point. But these expenses are no longer tax deductible. So what that means to me, I'm just not going to worry about that at all. It eliminates a big chunk of me having to maintain the receipts and try to categorize them, which is actually a good thing for me. And I actually won't even worry about that point at all. So in that same realm of ideas, let's talk about the next point, which is, in the past, certain business-related meals were 100% tax deductible. So, 100% tax deductible. And then there was other business meals that were limited to 50%. So, if you filed your taxes before and you've used TurboTax or some other software that I've used, there's a very specific question in there when you get to that point of business expenses, and it basically asks you, are these meal expenses for traveling? Like if you travel somewhere to take care of business, do you travel there for basically, like say you have rental property like myself, and I have to travel to Macon a lot, and when I go there, I have to eat. So technically, I should be able to deduct 50% of my meal expenses, and tax software is very specific on this and the IRS rules, because you would have to eat anywhere, in any case, whether you travel or not, so only 50% of it is tax deductible. But if you're actually entertaining a client or a guest in order to obtain business and you pay for their meal, that's a 100% business-related meal, and it's fully tax deductible. And also applies to if you have maybe some sort of a party, like a Christmas party for your employees. Again, the food that you buy, should be 100% tax deductible. Now, don't quote me on this. Make sure you go to the IRS website and you check up on these things. Check with your tax professionals, as I mentioned in the beginning of the show. But in 2018, all business meals will be limited to 50%. So what can we expect from this? Maybe parties are going to be reduced. I don't know. Depends on how you interpret this for your business. Now, meals are typically a very small portion of my business. Now, as I've mentioned before, I have several vacation rentals in the area. We used to offer our guests free food for breakfast, and it would be very simple, coffee, creamers, sugars, all that stuff, and maybe a couple cereals. We used to offer baguettes in the morning, and I've stopped that. That was just too much work. But all that food was tax deductible at some point, and now it's now only tax deductible to 50%. So you're going to see changes of businesses changing how they do business according to these new rules, if that makes sense. So we've already gotten through the 5 first points here out of the 16 that I wanted to talk about, and we're already at the bottom of the hour. So I'm going to have to do just a little bit of housekeeping here before I can continue with the next thing. And I'm going to play you some announcements here really briefly. Hopefully I can do this right. Just a moment here. Bear with me. And those were the Pet Shop Boys with the song Rent. Very fitting for my real estate show here, actually. I was able to find that yesterday. You're listening to Real Estate Real Talk with Julia M. Spencer. And today's show, we're talking about some of the tax implications of our new tax bill that was just signed into law a couple of days ago, and specifically how it applies to homeowners and real estate investors. But before we get to the next point, because bear with me here, you're going to have to put on your listening ears and concentrate with me, because I'm working through this myself. I want to tell you a little bit about our station here, because if you enjoy our programming on WRULP, we always ask you to please support the station with a donation. As an individual, you can give any amount, become a basic station member, or become a serious fan of the station. To check out membership rates and to donate to the station, go to www.wruu.org/individual and select to donate monthly or subscribe to an annual membership. Again, to donate to the station, go to www.wruu.org/individual and select to donate monthly or subscribe to an annual membership. Thank you for listening to and supporting WRULP. Now, you are listening, obviously, to WRULP, Savannah, Georgia, 107.5 FM, WRUU.org. We are Savannah Soundings Community Radio with Global Soul. Now, my name is Julia Spencer. I'm your host for Real Estate Real Talk. You can reach me at realestate@juliamspencer.com. I'm all over social media. Check out my Facebook. You can go to my YouTube channel. I have hundreds of videos, real estate related videos and other videos. Usually make videos wherever I am if I get questions from you all, very valued listeners and subscribers to all of my channels, and I try to research and poke around and see if I can get good answers for you. I've been in real estate investing for over 25 years. I've been there and done that. I'm what you call an expert because I've made all the mistakes that can possibly be made in a very, very small section. And I'm here to teach you all what I know. And as always, these are my opinions. You can take them or leave them. I would always recommend that you check with tax professionals, attorneys, real estate professionals, other real estate professionals, and investors. And verify my information as always, because it's always good to have a couple of people give an opinion on anything specific that I talk about on my shows. But let's get back to our topic here. Let's talk about something that I need, like I said, your listening ears a little bit about. I had to actually read this several times myself to understand it. But it's let's get to this next point. So if you are, and this has to do with depreciation and depreciation expenses, of course, as you know, if you're a real estate investor, depreciation is one of our largest expenses, our largest non-cash expenses. I always say that non-cash, meaning that you don't actually have to flip out your checkbook and actually pay somebody to get this expense written off at the end of the year off your taxes. And this applies for investors mainly, not really for homeowners, doesn't apply to them. But if you have real estate property that you own and you use it as a business, you're actually renting it out to somebody, or you use it as a vacation rental, you can depreciate that real estate, and you can also depreciate just about anything that's inside. So in case of a vacation rental, you can depreciate, I don't know, the dishes, the furniture, the couch, the sofa, the bed, the mattress, whatever. Everything is depreciable. Now, what I usually do though on my tax returns, if it's worth less than $100, I just expense it. There's an IRS rule where you don't really have to depreciate anything that's under $100. But everything that's over $100 ideally should be depreciated. And the IRS has tables where every asset is categorized under a specific asset class. And according to that class, it gets assigned a certain amount of years that you can depreciate it over. So it could be, this desk, you can appreciate it over 5 years, which means you take how much you paid for that, divide it by 5, and then you can subtract that 1/5 amount of the value of that desk off your final tax bill as an expense, as a depreciation expense. And the same goes for the actual real estate itself. But there's a couple of IRS traps here, of course. And this was pointed out to me several times, and I'm not ignorant to this in my videos, but my videos on YouTube are very, very simple. They're for really anybody to understand. But if you're depreciating real estate, you really need to take out the value of the land. So if you purchase a piece of real estate for $200,000 and the land is worth $50,000 off of that, then you really can only depreciate $150,000 of that entire real estate purchase. And how do you determine how much the worth of the land is versus the building that's on it? Well, there's ways to do that. I do it via property cards. You can do it with an appraisal. I mean, there's a number of things that you can do it, but we're getting sidetracked. So let's get back to this point. So in terms of the taxes for 2018, and even if you purchase them after September 27th of 2017, and you're an investor, so business assets like equipment, furniture, fixtures, appliances, computer, there is now a 100% bonus depreciation deduction available if the asset is purchased after September 27th, 2017. So that's basically what that means is there's an immediate write-off of the expense versus the need to depreciate it over time. So this kind of flows in exactly with what I just said. Like, say you bought a computer, let's say you bought a Mac or something expensive for, let's say it cost you $1,500, you bought a MacBook Pro. And normally you'd have to depreciate that over that asset class amount of years. I don't know what it is exactly, let's just say it's 5 years. So you'd have to basically divide $1,500 by 5, and then you take that 1/5 amount, and that's your depreciation expense that you can write off this year, 2017, 2018, and for 5 years basically. But now with the new tax laws, you can actually, if you use that computer exclusively for real estate activities, you can now basically deduct 100% off of that expense immediately. And as we all know, the time value of money in your pocket today is worth more than the same amount of money 5 years from now. So this is a really good thing. This is something very good. There's some good things to be had with having a president who is a real estate person in power. I don't want to talk politics on the show, but part of this is very beneficial for us real estate investors. And this new rule actually also even applies to both new and used items. So in the past, what you'd have to do is with the used items, you kind of had to gauge the value of it a little bit. So, and also try to figure out what the actual market value of that is, since it's a used item. And that applies for my vacation rental business a lot, just because a lot of the things that I buy are used, especially the furniture. But this bonus depreciation actually applies to both new and used items. So if you're purchasing any kind of business assets for real estate activities, you can get this bonus depreciation, just 100% bonus depreciation. So you can actually even still get it for 2017. So just keep that in mind when you file your taxes. Now, another cool thing about this particular point is that this bonus depreciation can actually also be applied to vehicles. And specifically, of course, vehicles that are used in real estate business. But you have to, again, ask your tax professional. As I always say, there are certain limitations. And in my case, I drive a very nice vehicle, and I use it primarily for real estate business. I use it for personal uses also, obviously, but it's primarily my vehicle for real estate activities, because that's all I do. I do have a secondary vehicle that's a private vehicle, and but the nicer vehicle is my business vehicle. So I actually have a lot of expenses associated with having a vehicle, and that's a very nice write-off to have. And the next point, number 7, and we're actually getting to be, we're wow, I'm just looking at the time. It's 12:46. Wow, I can talk about taxes all day long. Let's talk about this next point, which kind of plays into that a little bit. So, Section 179 now allows for certain taxpayers to take an immediate deduction of up to $1 million on assets placed in service for a business. This kind of plays in with the previous point that I just mentioned. But in the past, this excluded real estate activities, but starting in 2018, this is now available to non-residential real estate and appears to be available for lodging businesses such as dormitory and Airbnb. So, examples of eligible assets may include roofing, heating, HVAC, fire protection, and security systems. Now, an immediate deduction of up to $1 million on assets placed in service for a business. This is actually pretty significant. And especially, it very much applies to me. So we're talking about the fact that if I have to get a roof on any of my real estate, and generally roofs for my pieces of real estate run anywhere from $4,000 to $8,000. HVAC systems, another thing that's very, very expensive. Heating, these things I used to have to depreciate over time, and again, now I can take up to $1 million of these assets that are placed in service for business on my real estate immediately. I don't have to depreciate it over time, and so this is actually pretty good. This is a really good law for us small investors here. I'm definitely going to look into making some improvements to my real estate, and hopefully I can make use of this point. Now, as we are speaking here, I wanted to just go ahead and remind you that you're listening to WRUU-LP, Savannah, Georgia, 107.5 FM. WRUU, we are Savannah Soundings Community Radio with Global Soul. And I'm going to look at these next few points that I have here. And in the meantime, I will play you a song, and I will be right back. And that was Morrissey with Tomorrow. I don't know about you, but I grew up with Morrissey, so whenever it's a dreary, rainy day out there, it reminds me of Great Britain and my trips there. And that's where he's from, and that's the music I listen to on days like today. Anyways, we are almost at the top of the hour. Can you believe it? It seems like the hour always goes by so fast when I'm here. I love being on the radio, by the way. I'm a volunteer here at WRUU, and I just love being here. Today's show, Real Estate Real Talk, and I'm going to talk about really briefly about one more thing here. I'm going to try to squeeze that into my last 5 minutes here. We're talking about some of the implications of the new tax bill, specifically for real estate investors and homeowners, and partially also as it applies to other business owners. And I want to just talk about some of these points. And by the way, if you want to read the whole article, you need to go to biggerpockets.com. You don't have to go there, but that's where I got the information from. And it basically just kind of summarizes it as it applies to real estate. And I wanted to read this article and kind of just give my own interpretations and opinions about some of these points. And of course, as real estate investors, we watch the tax bill changes very carefully. I've watched them very carefully just because it applies to my bottom line, as always. But let's just squeeze in a few quick points, and I'm going to kind of go out of order here. There was a proposition to accelerate depreciation of actual commercial and rental properties, but the final bill did not give us that tax benefit, unfortunately. So when you depreciate residential and commercial properties, it remains 27.5 years. And for commercial, of course, it's 39 years, actually. So you take the value of the real estate minus the land value divided by 27.5 years. That's your depreciation that you get each year for each piece of real estate that you own. And you divide it by 39 years if it's commercial property. Now, in terms of depreciation, again, I talk about that a lot because it's actually a big topic here. But I actually have a YouTube video that I made, and it's called How to Accelerate Your Depreciation Expenses on Your Real Estate Investments, and specifically on other items in your portfolio that are part of your real estate, such as appliances, roof, and things like that, and anything that you have in the home. That kind of is OBE with the new tax bill, but if you are so inclined, feel free to check it out. It's on my YouTube channel. It's free to watch. And for more information, you can go check that out. One last point, very last point here I wanted to make. I have only a few minutes here. In the past, your tax preparation fees used to be tax deductible as an itemized deduction. However, in 2018, they're no longer deductible. So, here's a little work around this. You used to be able to put that as an itemized deduction. For me, it's not very much because I do my own taxes, but I do have to pay for the software. But if you're paying a tax professional, sometimes $100 an hour, that's a pretty big expense for most of us. What you should do if you're a real estate investor, here is some very personal advice from Julia M. Spencer. Make sure that instead of deducting it as an itemized deduction, that you actually allocate that expense against a percentage of each one of your properties on Schedule E, so you can lock in that tax benefit instead of using it as an itemized deduction of your entire tax bill. So that's kind of like my last tip for the day. And I hope you found the show very entertaining and enlightening, informational. More tax tips to come in future shows, as always. I hope you like my songs. I'm playing my own songs instead of musical interludes as well, so feel free to give me feedback on that, as always. Now, don't forget, I'm going to be in the air for about 4 hours in a row on New Year's Eve. I'm going to have a very special show. We're going to play all kinds of really cool tracks from the early 90s, late 80s. I have a guest DJ here in town from Daytona Beach, DJ Luke, and we'll have a blast. So tune in. I'm going to do Sister Sound for Josephine, still out of town, from 1 to 2 p.m. and from 2 to 5 p.m. I will be spinning the New Year's Eve party, so join me there, and I hope you have a great rest of your week and an awesome jump or slide into the new year.
For your free guide to real estate investing, visit juliamspencer.com.